In this video, traders, let's explore some trailing stop loss ideas, 5 to be precise. Stick around. Hey traders, warm welcome to you. All right, so trailing stop, I know it's controversial, trailing, it's not controversial, it's not we're talking politics here, religion, but it's kind of some people are one camp or the other, like, oh, I don't think you should trail stop, I think you should do this and do that. But I think there's time and place for trailing. For me, most of the time, I'm not going to use a full clip and trail a full clip. I'd probably trade into a trade. My average trade would be like, okay, buy a position, maybe add some more if it's looking good. Then come out as I'm reaching the target, hit the target, start to come out. And if I'm in my mind, I'm like, okay, you know, this could really continue. It's done what I wanted to do. I've taken a good profit from it, A to B, but maybe there's a little bit more. I might leave a chunk on and then put it into a trailing condition. So I'm like, okay, I'm happy to leave a chunk on, I'm happy to lose a little bit or risk a little bit out of that last quarter or whatever. I'm risking 20% of the trade size, and I'll put the stop there and then I'll trail it using this strategy. And you know, who knows where it could go. And so these are the kind of things that you could use in this scenario. I'm looking at the ones that I like, and interested to know the ones that you like as well. So stair-stepping effect, this is a stair-stepping effect, you guys know this. When you put a low and you come out to high, there are different kind of rules and ways you can approach this, but generally speaking, a low's put in, it goes out to a high, your stop goes there. A low's put in, goes back through the high, your stop goes there, your stop goes there, your stop goes there, that type of thing. Now, if you've got the right environment, that's great because it keeps you in the trade for as long as it comes. Sometimes you might end up getting stopped out, like if that had come up to the highs there and then come down, you might get stopped out. So there's no perfect solution for this, but it's one way of looking at it. And it's quite simple. Quite easy to do, but it does mean that you have to monitor the market. You have to sit there and watch it, and you kind of see when it goes to the high and then drag your stop up through. I guess you could probably code something, but it's not native to an app like was on fixed pips. Let's go to number 3, fixed pips. I thought it was number 2, but let's do that. Fixed pips, you can actually most of the time program that in your broker's app or broker's platform, and that just basically says, hey, I want to use a 50 pip trailing stop, so as the market goes up, the 50 pips will come up with it. Let's see if you can see that. As it comes up, as it comes down, it will stay stagnant. It's like a ratchet system. Comes down 30, goes back up again, it'll go up, comes back down, and eventually it comes down, stops you out. And that can keep you in a trade for a long period of time. So it's a kind of stair stepping, but it's not manual. It kind of goes up with every single move. So it just goes ding, 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 and then hopefully it doesn't come back 50 pips and it keeps you in the trade. All right, let's go back to number 2. Under over moving average, let's use under for the case of a long. So you might have a moving average. You say, hey, when we tag it or close underneath it, depending on time frame using, I'll come out of the trade. So, and again, this is, you don't, by the way, probably should have said this at the beginning, you don't want to start playing the trailing stop loss game if you're trading a mean reversion type trade. Maybe kind of some of the scenarios where maybe if you're going from up a Bollinger Band or a top type of band type trade, double top, back to a VWAP, and you think that's just a precursor for a break lower, fine. But I guess the point is you've got to expect an expansion of some sort, even if that's coming off mean reversion to a kind of expansion. But really, let's kind of simplify and say we're in a trending type environment. You're trying to capture the trend and as much of the trend as possible. Under over moving average, I think we talked about some of these parameters before. 20 period kind of keeps you in some of those little pullbacks, and will probably, you know, obviously the tighter moving average, using an example, a 5 period moving average will keep you in a very hard momentum breakout. So I will use a 5 if we're kind of just flushing, like we're flushing through lows, and I think, hey, that's exhaustion, but you know, we could go further. 5 moving average is very, very tight to price, and that keeps you out, gets you out in the slightest little retracement back. So that's good when you want to get out, but you're kind of looking to extract the last little bit. A 10 and a 20 gives more room for pullbacks, and then it will get you out on a deeper pullback. So a 10 period, again, obviously sits somewhere in the middle in terms of where it positions on chart, but you know, 20 period will kind of sit like this. You know, 5 period might get you out on this kind of thing. But what happens is, you know, 20 period will hold on the deeper pullbacks and then eventually get you out. So it depends what you're trying to achieve. If you think that it's, you know, a kind of real strong momentum move, you want to use a tight moving average or low or fast moving average to be precise. You kind of widen it out, use a slower moving average if you're prepared and you want to capture a trend, but you're obviously going to give some back. So that's one way of doing it, over on a moving average. I don't like that so much. Now and then I might use it like a 5 if I'm trading stuff, but most of the time if I'm really trying to do that, I'll probably be looking for exhaustion on the tape. Yeah, I think this is a good way of doing it. I'm not a big fan of this either. I think it's too automatic and doesn't allow for dynamic adjustment. Like if you suddenly get a blow off top, you know, often that is going to get you out on that, but really you kind of want to see how it responds after that. So yeah, under over last X bar, high or low. I quite like this. It's quite simple and it's quite easy to do. So if you've got a 5-minute chart, for example, you might see the price going. You say, hey, I'm just going to come out, if you're long, I'm going to come out if we break the prior candle low, or prior second candle low if you want to. So that just kind of keeps you in when you get those big long bars. It gives you a bit more room. Obviously the stop's a bit wider. When it's congesting and consolidating, your stop obviously then gets ratcheted up. So there's a downside to that, as there's all of them, but I think that's quite a nice way of doing it. I quite like doing that from time to time. X minutes later. So what I mean by this is you basically say, okay, I'm not going to look at price. I'm not going to look at price. I am going to just hold this trade and have your stop, your fixed stop, or however your first position is allocated. Then I'm going to see what happens in 15 minutes. Then after 15 minutes, I'm going to adjust my stop. And your adjustment can be a percentage of the move, 50% of the move, say. It can be under a key level. It can be, you know, dynamic, and you can adjust that as you want. But what you're doing is you're allowing time to work in your favor. And I really like this kind of perspective. Again, depends on what you're trying to achieve with the trade. But I like this because you're saying, okay, I'm going to come back in 30 minutes. I'm going to see where we are. And you come back in 30 minutes and you look and you say, all right, that's interesting. We're holding at highs. Okay, I'll put my stop there. You might see a rejection. Now, the disadvantage, of course, is that you might miss something that you can capitalize on. But at the end of the day, let's think of the real world. Most of the time, most of us will, if we're managing a trade and watching every tick, will come out way sooner than we should do. We will always default to finding a reason to close a trade. So this puts you in a discomfort mode of, hey, I'm going to hold this trade for at least this period of time, come back in, adjust the stop, another 30 minutes, come back in, adjust the stop, another 30 minutes. So it means that you can just take the burden of constant trade management off your shoulders. You don't have to be sitting in front of the screen. You don't have to be doing anything other than, hey, got my stop in. And of course, market might go up and come back, and that's always the counter argument for it. But that's just as likely as the market carrying on up and up and up and up, and you come back 30 minutes later, whoa, that's moved massively. What do I want to do this? Well, I'll tighten the stop up to here, I'll do this and play this game. So I think most of us are on the side of taking profits too soon. So if you can kind of force yourself to at least hold profits and give back some at the end, you probably find you end up with more over the number of trades that you're kind of looking at. So some trading stop loss ideas, 5 there for you. There's a few more out there. Let me know in the comment section below. How do you like to trail your stop loss? Do you even bother with the trading stop loss? You're like, nah, fixed stop, fixed target, that's it. I won't even move my stop. Or do you kind of move it up manually? I suppose there's a manual option there of going, where do I want to move it? Adjust it based on the price action that I've seen, protect my profits based on the structure of the chart. Yeah, that's one way of doing it. But these are 5 trading stop loss ideas. Keep your risk managed. See you next one. Bye-bye.